This is Kevin Barry of the Traders and Investors Club. This is a reprise of a presentation that I gave at the World Money Show in London in early November, dealing with the question, is it really possible to outperform the stock market? The answer is yes, and I will show you how to do it using a very underutilized stock selection system known as sector rotation. Warren Buffett once said, "A rising tide lifts all yachts." What could he have possibly meant by that? To answer that question, we need to look at what actually moves the price of a stock. The answer is surprising. The overall market accounts for half of the price movement of any individual stock. You can see this in action for yourself. During a bear market, almost all stocks are taken south, irrespective of how fundamentally solid the company might be. Secondly, the industry or sector in which the stock resides accounts for 30% of the movement of that stock. And finally, the fundamentals of the individual stock itself accounts for just 20% of the individual stock price movement. So what is a sector? Well, a sector is a group of securities in the same industry or market. Let's take a look at the oil and gas supersector. Now you can see within the oil and gas supersector we've got three sectors: oil and gas producers, oil equipment and alternative energy. And within the sectors we've got subsectors. And the subsector groups stocks in the same business together. Now the next thing we need to understand is the economic cycle. This diagram shows a typical economic cycle. The economy peaks, contracts into a trough, expands again up to another peak, and so the cycle continues. The average time for each cycle is around about 5 years. Here's another way of looking at exactly the same thing. We've got 5 stages: early contraction, late contraction, early expansion, middle expansion, and late expansion. Now the interesting thing about this is that at each stage of the economic cycle, certain sectors do better than other sectors. So the basic idea behind the sector rotation model is that we rotate into stocks within the sectors that are performing best depending upon where we are within the economic cycle. So the question is can we use this technique to outperform the stock market? If we were to have bought and held the S&P throughout the whole period, we would have now got $6,000 in our trading account. If we'd used some kind of market timing strategy, such as perhaps a moving average crossover strategy, we could have probably done twice as well and have $15,000 in our account now. However, if we'd used a sector rotation model and only invested in the best performing stocks in the best performing sectors, we would have increased our starting capital by almost 63 times. Not too shabby. The point I'm trying to make here is that if you start with a top-down strategy, i.e. pay attention to which way the market is moving, and then within the market select the strongest sectors, and within the strongest sectors select the strongest stocks, this is how you get to beat the market. Ironically, most investors do not approach the stock market in this way. When I did a straw poll during the presentation of the Money Show, just to find out how many stock pickers actually took any notice of the general market and sectors within the market before choosing their stocks, very few people appear to do so. So, this is going to be our edge. In the ideal world, we'd like to rotate out of sectors just beginning to weaken and into sectors just beginning to strengthen using the economic cycle. However, the problem is that we can't always detect where we are in the economic cycle until afterwards. And also within the economic cycle, the sectors don't always behave themselves as we'd like them to. So consequently, what we're going to do is we're going to do our own analysis on a regular basis to detect which sectors are performing the best. Now the tool we're going to use to do this is called External Relative Strength Analysis, or ERSA for short. And let's take a look at why we should use this tool and what it tells us. Now first of all, let's talk about what ERSA is not. ERSA is not Wilder's RSI indicator. It's also not the comparative relative strength, which compares the performance of a security against an index. In order to find the leading stocks in the leading sectors, what we want to do is compare the price rate of change over a set number of periods. Now, what is the price rate of change? Let's pull up a couple of graphs, and hopefully I'll be able to show you exactly why we use the price rate of change. Now, on the left we have Citigroup, and on the right we have IBM. Citigroup trades, or has been trading towards the end of October, around about $37, $38 a share, whereas IBM has been trading around about $195 a share. Now what this means is that a $5 move in the market equates to a 13.5% move in the value of a Citigroup share, whereas a $5 move on IBM only equates to 2.5%. So consequently, we're not really comparing eggs to eggs if we're only using the stock price. So what we do is we plot the 10-day rate of change. So rather than using the price chart alone, we're going to plot the 10-day rate of change indicator underneath each chart. I'm not going to spend too much time talking about the rate of change indicator, because you'll be able to find information about this indicator anywhere on the internet. But what the rate of change indicator allows us to do, it allows us to plot the percentage change of a price chart rather than just the change in dollar terms. So what this tells us is over the last 10 days, the Citigroup share price has increased by 2%, whereas the IBM share price has dropped by 7%. Now, what we're going to do is use ERSA to find the leading stocks in the leading sectors, and this entails comparing the price rate of change over a set number of periods. First of all, we're going to find out which sectors are outperforming. And once we've identified that, we're going to look in the strongest sectors for the outperforming securities within that sector. We're effectively going to sort the sectors by rate of change and the securities within them by rate of change, and we're going to apply percentile ranking. So the top 1% of sectors, for example, get a rating of 99, the next 1% gets a rating of 98, etc. And by the way, this is the technique used by the Investors Business Daily. In order to carry out this ranking, I'm using Metastock purely because it's what I used to trade with. However, most charting packages should enable you to do these kind of calculations. Excel certainly does. The first thing we're going to do is run our analysis on the 19 Dow Jones super sectors. And this is what it looks like. Here we can see the analysis I've done on the super sectors dated the 4th of September 2012. And we obviously have the sector name over here. And in this column here we have the latest 10-day rate of change ranking. So this is ranked by external relative strength, as you can see. Now the other columns, we have the value for 5 days ago, 21 days ago, 60 days ago, etc. And what this enables us to do is just really at a glance to see if the sector is strengthening or weakening. As you can see here, the top sector, the media index, that's been strengthening now really throughout the last year. And so consequently, this is going to be a very good sector for our attention. This is the top performing sector, the media index. So the next thing we want to do is run an external relative strength analysis on all of the stocks within the media sector. And this is the result. As you can see, the top 3 performing stocks in the media super sector are the New York Times, Scripps Networks and Liberty. The important thing to realize here is this is not a trading system within its own right. What we're doing here, we're first of all identifying that the market is rising. Given the market is rising, we then identify the strongest sectors within the market, i.e. the sectors that are outperforming at the moment. And within the outperforming sectors, we're looking for the outperforming stocks. That doesn't mean that we now just go out and buy these stocks blindly. We have to examine them within the framework of our own trading criteria to make sure that we're happy with those stocks. But what we've got here, we've got stocks which have got huge momentum within the market, and in the absence of anything changing, we expect the momentum to continue building. Okay, first of all, let's take a look at the New York Times. Remember, this analysis has been done a couple of months or so before the money show. The chart looks very, very strong indeed, nicely above its 50-day moving average. So, to me, that's looking pretty good. The second strongest stock in the media super sector is Scripps Networks. Once again, above its 50-day moving average, definitely in an uptrend. And likewise Liberty Cap. Now, another way of looking at these stocks, we can use stockcharts.com, and StockCharts allows us to also do an external relative strength analysis in a similar way, but in a graphical format. And here you can see the red line is the S&P 500, and the purple line is the media super sector, and you can see straight away how the media super sector is outperforming the S&P. And within the super sector, we've got New York Times, Scripps Networks, and Liberty Capital. The takeaway here is to see how, first of all, we identify the strongest sector, and within the strongest sector, the strongest stocks. And now that gives us a universe from where we can now start choosing which stocks we're actually going to buy. Now let's take a look at the second strongest sector, which is the telecommunications index. Same thing, we now run our external relative strength analysis on every stock within the telecommunications super sector. We've got a couple of good candidates here. We've got Sprint Corp, Cincinnati Bell, and Frontier Communications. Sprint Corp, well, obviously in a strong uptrend, as is Cincinnati Bell, as is Frontier Communications. Okay, now what happened next? Remember that I took these charts a couple of months before the original presentation. If we first of all look at the S&P 500 index, now let's plot technical on here. Here is the channel showing that the S&P was in an uptrend. So about the first week of November, it's broken out through the lower trend line, and from being bullish, now we are now starting to be a little bit bearish. Remember, this is the beginning of November. Now, from being in a very strong upward channel since the middle of 2012, we've now got the first signs that there may be a trend reversal. Let's take a look at the S&P with, which is here in red, with the media sector and the telecommunications sector plotted. Now, the interesting thing is that we've been going up quite nicely, and with the market, we've now started getting a downturn in both sectors. And here's New York Times. You wouldn't want to still be in this trade, but this is where we did our external relative strength analysis, and as you can see, it didn't perform too badly, really, just until the last few days. And if you remember back to the S&P channel that we've looked at, that would have happened more or less around about the same time that the S&P started to weaken. Now, Scripps Networking, here the green arrow indicates where we did our external relative strength analysis. As you can see, there was a nice bit of mileage in that stock. Once again, it's coming off. So very, very important to keep an eye on the general market, and also very important to keep an eye on the sector if you're trading this strategy. Very similar picture with Liberty Cap. We came off a little bit after doing the external strength analysis, but we've taken off again. And I can't reiterate strongly enough that this is not a trading strategy in its own right. It's very important that you are happy with the technicals or the fundamentals, whichever way you want to trade, of the stock that you've chosen before you actually pull the trigger. Sprint Corp, we've had a gap up, which could well have been earnings or some other fundamental reason, and the stock continues. It's fallen back a little bit, but it's performing pretty well. Right, Cincinnati Bell, quite a nice rise where we did our analysis. Once again, that's coming off as well. And Frontier Communications, well, it's pretty much trod water over the last couple of months, but still, it just really goes to illustrate the idea that not every stock that comes to the top in this analysis is going to be a goer. Once again, you've got to make your own decision about that. Now, being the money show, most people that come along to the presentations are far more interested in what's going to happen in the future than what's actually happened in the past. So I did the external relative strength analysis just really at the end of the week, just before the money show. And let's have a look at what came to the top of the heap. So here it is, the external relative strength analysis for the 31st of October. The strongest performing sector now is the construction and materials index. And as you can see, the media index has slipped down to a number 2. The telecoms index is falling out of favour totally at the moment. And you can see here how it's actually weakening, or has been weakening over the last couple of months. So here's the same information on stock charts. We've got here the S&P 500. And the top 4 performing sectors at the moment, we're particularly interested in the construction and materials sector. So currently, the top 2 stocks within the construction and materials sector are USG and Eagle Materials. So here is the chart for USG. Excuse the typo up here. UNG is the ticker for the natural gas ETF, which has been playing on my mind for the whole of the year, so please excuse the typo. Technically, this is a very strong picture indeed. We've got decent support from the 50-day moving average. If we plot the Fibonacci levels from the most recent low to, well, the most recent high, we can see here that we've got a textbook retracement and solid support here at the 61.8% fib level. Now that to me is a very strong looking pattern, and I'd be very happy to take a long position with this stock. Okay, the second best performing stock within the sector is Eagle Materials. Once again, comfortably above the 50-day moving average. It's definitely in an uptrend, and in fact it's in a beautiful trading channel here. Once again, I'd be very happy to go long this stock. In this case, my stop would be just outside of the lower trend line. Now, just before we take the plunge with those stocks, it's very important once again to go back and check that the sector itself is still looks strong from a technical or a fundamental perspective, whichever way you want to look at it. The proxy really for the construction super sector is the iShares Home Construction ETF, which is the ticker's ITB. This has got a very nice bullish pennant here. As you can see, we've got support, resistance. Technically, this is a very strong pattern, and I would expect a breakout. Now, for those of you very tight on time, I'm now going to show you a strategy using the sector rotation principle, which is going to take you all of 10 minutes every month to operate. Now, you also don't need to worry about running external relative strength analysis either, as I'll explain. Now we're going to narrow our universe to just 10 of the iShares sector ETFs, which you can see here: utility, consumer services, energy, financials, healthcare, industrial, consumer goods, basic materials, technology and communications. And if you remember back to our economic cycle diagram, you should recognize all of these sectors from the diagram. Now, in order to complete the strategy, we're also going to add the long-term Treasury bonds ETF, and the ticker for that is TLT. And I'll explain why as we go along. Now, here is the strategy. At month end, you rank the 10 ETFs based upon their 6-month total return. And really, all that means is that how they've performed percentage-wise in the last 6 months, just so as you can compare one against the other. Now, by the way, if you don't want to do the calculations yourself, if you look at the Seeking Alpha site, we'll do it for you. The next day, you buy the top 2 ETFs if they're above their 6-month moving average. Obviously, if you've already got them from the previous month, you hold on to them. If one or both ETFs is below their 6-month moving average, buy TLT bonds ETF. Now, why we're doing this is because, remember, this strategy is going to be always in the market, irrespective of what the stock market is doing. Now, if both ETFs or one or both ETFs is below their 6-month moving average, what's that telling us? That's telling us that the market is in a downturn. You can confirm that yourself probably by just looking at the chart of the S&P or even the FTSE. Traditionally, bonds have got an inverse correlation with the stock market. So, i.e., if stocks are going up, bonds are going down, and vice versa. So what we're doing here, we're really moving our investment out of the stock market and into the bond market. And it's pretty straightforward. We repeat every month, and of course we're going to cycle back out of bonds if and when the stock market sectors actually start popping up above their 6-month moving average again. Let's have a look at how this performed really over the last 10 years. Here we've got results of this strategy. Here we've got the return from the S&P 500 in the form of the SPY ETF. And this is really not too shabby at all. As you can see, every year in the last 10, the sector rotation strategy has returned a positive return. But the interesting thing is to look at the outperformance, and it has to be pointed out that in 2004 and 2010, the rotation strategy underperformed the S&P itself. No strategy in the world is going to outperform every single month or every single year, but this strategy is about as close as you're going to be able to get to seriously outperforming the market. Come and have a look at the website, tradersinvestorsclub.co.uk. We've got a lot of other investment ideas on there. I hope that you've enjoyed the presentation and that you can take something from it that you can use for your own investment strategy. Thanks for listening, and look forward to seeing you next time around.